So in today's video, we're going to focus on bank reconciliations. So let's take a look at the debit and credit postings in both the bank statement and the Cashbook and why that's important. I think the why is always important to discuss because if you're not sure about why you're doing something, then the methodology on how to do something is going to be that much more difficult. Now, a quick stats check before we get started. 72.5% of students who take the Principles of Bookkeeping Controls pass first time. So let's get that number higher. So essentially, if we were looking at a client's accounts, what we're going to have is a bank statement, a physical statement from the bank. And I'm sure we've all had one of those before today, either online or in paper format. And what we're going to have is what we call a Cashbook in the bookkeeping system. Now, naturally, there's going to be potentially differences between what that bank statement is saying is the balance carried forward or even brought forward, and what our Cashbook is saying is the balance brought forward and the balance carried down. And the reason for that, and it makes complete sense, is because of things like timing differences, or because on the bank statement you might have automatic payments that are going on, like direct debits and standing orders, that are not included in your Cashbook because you don't have an invoice, etc. So you're not naturally going to post those into the Cashbook immediately. Similarly, you might have bank interest and bank charges that you've paid out of the bank that are on the bank statement and not in the Cashbook. And the other way around, we might also have something in the Cashbook, like a check, for example, that we know we have paid. However, it might not appear on the bank statement in that time period because of a timing difference. So let's say we paid it on the 30th of September. It might only appear in the bank 3 days later, on the 3rd of October, for example. So when we run the bank statement up to the 30th of September, it's not going to be there. We might also have differences brought forward. So again, maybe a check that was posted in the last Cashbook that's appearing on this bank statement because of the reasons I've just stated, and so on. So just a quick one, just to let you know that the mock exams are now available on Rebecca's Finance Tutorials on Podia, and if there's a mock exam that you don't see or a particular subject that you need help on, let me know and I can create a mock for that. So otherwise, let's get back to the video. So what you can see on the left here is a copy of a bank statement. So typical bank statement that you're going to receive from any bank, you're going to have your date on there, there's going to be some details, there's going to be a paid out and paid in, and there's going to be a balance. So the biggest reason why a bank statement and a Cashbook might look different is because from the bank's point of view, so with the bank statement, the money in their account is a liability. And that's because they owe you. So they owe the sole trader or they owe the limited company, for example. So when you deposit money into the bank credits your account. When you withdraw or spend money, the bank debits your account. So if I was to look at this from the business's point of view or the sole trader's point of view, and I'm looking at the Cashbook, money in the bank for me is an asset. So when we receive money, we're going to debit the bank account in the ledger. So aka it's going to go on the left. And when we make a payment, we're going to credit the bank account, so it's going to go on the right. So that's why, again, when we're looking at a debit versus credit perspective on the bank statement versus Cashbook, it can get a little bit complicated. So again, we're going to summarize that. So from the bank's point of view, when we look at the bank statement, when you deposit money, the bank credits your account, aka, in other words, that's a liability. It's going to show up on the right-hand side. When you withdraw or spend money, the bank debits your account. So debits show up on the left side, as you can see here. So I hope that made sense. Go over to the Cashbook, and from the business perspective, money in the bank is an asset. So again, when you receive money, you're going to debit the bank account in the ledger, aka that's going to go on the left-hand side of the Cashbook. When you make payments, you're going to credit your bank account. In other words, that's going to go on the right-hand side of the Cashbook. So that's why the same transaction appears on the opposite side of the two records. So top tip, I would always, when looking at double entry, go from the balance sheet of the company that you're looking at in terms of where debits and credits should be. And what I mean by that is if you can understand that money in the bank for you as your business is going to show as a debit, so an asset, on your balance sheet, then you can understand that the other side of that, so from the bank's point of view, that will be a liability. So let's take a look at what a Cashbook would look like then. So the Cashbook is going to be recording money coming in and money going out. So the balance that's in the cash book is going to be increased by those entries on the left, aka the debit entries, because that's money coming in, and it's going to go down if we've got items on the right, aka credit entries. And these are going to be where we're paying money out, essentially. Now, one key area that students tend to get wrong or fall down on is when it comes to balance brought down, balance carried down. And you might also see this as balance brought forward and balance carried forward as well. Now, if we've got a balance brought forward or balance brought down on the left-hand side, as we can see here, that means that we had a positive bank balance. We had an asset at the end of the closing balance just gone. So let's just say on the 28th of February, we had a balance brought forward that was an asset of £10,000. Now, when we close off the account by reconciling it and adding it all up and having these tallies at the end, what we'll find is if we've got a balance carried forward or balance carried down on the right hand side, that means that we've got an asset still. Now, if we switch this over, if you see a cash book that looks like this, and on the 1st of March we've got a balance brought forward or balance brought down on the right, that means that our closing balance had a liability in the bank as at the 28th of February. Similarly, if our balance carried forward or balance carried down at the end of the reconciliation process is on the left-hand side of this cash book, it means again we've got a liability in our bank. Now, the two of these can change, so you could have a balance brought forward that's a liability and a balance carried forward that's an asset. That can happen, and vice versa, as you can see here in this example. Do not get confused. That's something that the examiner might just throw at you just to test you on the day, because we know that they like to do that, but do not get panicked. Just think about this logically, look at these examples, go back through this video 100 times if you have to, and really nail that, because it can throw you off in the heat of the moment. So that's the end of today's video, and in the next we're going to have a look at time and differences between both the cash book and also the bank statement. So I'll catch you at the next one.